Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 16th day of April, 2019. Always like to tell you that I write a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and would appreciate your subscription. Your subscriptions to, you can go to miningstocks.com, or call our office here in New York at 718-457-1426, 718-457-1426. Also like to encourage you to consider signing up for Chen Lin's letter, What is Chen Buying, What is Chen Selling? Go to chenpicks.com to do that. And I want to thank each of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. And would like to invite you to keep your questions, comments, criticisms, whatever remarks you have coming along to questionsfortaylor@gmail.com, questions, the number 4, Taylor@gmail.com. We do want to thank our sponsors for making this show. And this week we have 2 new sponsors. Well, actually, Auryn Resources is back as a sponsor. They've been with us before, and we'll be talking to Ivan Bebek, the company's executive chairman, in just a few minutes from now. Also joining us this week is Strike Point Gold. It is joining us for the first time, a new company that one I think has a great deal of promise, and both of those are companies that I cover in Jay Taylor's Gold, Energy, and Tech Stocks. Besides those 2 new sponsors, Novo Resources, Miramont Resources, Great Bear Resources, and Klondike Gold are all sponsors for this week's show. I've titled today's show, Why Do Central Bank Counterfeiters Like Gold? Today we'll have Danielle DiMartino Booth with us, Ivan Bebek, and Michael Oliver also. Monetary counterfeiting is theft. That's why they put people in jail for doing it. But by way of force, central bankers do the same thing legally to the detriment of workers who produce goods and services. During a period of economic growth, not many care about the topic of central bank counterfeiting injustice, but when the music stops and sudden liquidity and insolvency prevail, retribution follows. Beginning on page 209 of Danielle DiMartino Booth's book, titled Fed Up, she explains how central bank quantitative easing sets up liquidity traps that are impossible to exit, again, demonstrated just recently by the Powell pivot. With the inevitability of a liquidity crisis staring them in the face, are central bankers once again counting on gold revaluation to bail them out, as they did in 1932? Well, some people think so. But we'll see what Danielle has to say about that topic and others related to that as we talk to her in the second half of today's show. Ivan Bebek will update us on some exciting developments for Auryn Resources in Peru. Really exciting things, I think, are taking place there. It is one of my favorite stocks personally, and I own it personally. And, of course, as I said, it's recommended in my newsletter. But right now I'm happy to tell you that the ever-reliable Michael Oliver is with us to help us understand if we should get really worried about today's decline in the gold market. Thanks for joining me again, Michael.
Good to be back, Jay.
Yeah, it is always good to have you. It's good to have you every week because you do have a way of helping us keep the markets in perspective, and a lot of us are a bit emotional. We see big moves in a given day, and we say, uh-oh, and we exit way too soon, just about the time we ought to be adding to our positions rather than exiting. But I should tell everyone, again, it's olivermsa.com, olivermsa.com, to really take advantage of what Michael has to offer. He provides some goodies to us here, but if you really want to benefit, you need to get his daily missives almost daily. Almost every day he sends something out on one market or the other, especially if you're a subscriber to his more extensive service. There's just endless numbers of markets that he provides great advice about those markets. So, Michael, we're seeing quite a day in the gold markets today, not a good one for those of us that are bullish. How are you looking at things now in the market, the gold market?
Well, we recognize the corrective process that's been underway actually since the December high. Late December, it traded over 1,300 on the front month. Gold gained some more ground into January and February, get up to 1340 plus, but there have been quite a few sell-offs since the December high, February high, March high, $30, $40 swings downside that don't get any traction. Mm-hmm. In the process of that action, price action of gold, it has set up an orthodox, what the price charters call a head and shoulder top.
Mm-hmm.
And this spans going back to late December anyway. And if you see it, it's almost a perfect one. It couldn't be better, textbook. So, when we respect price chart analysis, but as a secondary attribute of market analysis, we look at momentum primarily of price. And often, momentum action, when you plot it, either agrees or doesn't agree with what price is attempting to say or doing. Mm-hmm. And frankly, right now, the momentum action since late December is aged on the downside, meaning there's been enough downswings in momentum that have set up a structure that if you looked at the momentum chart, you see a trend line coming down across too many highs, meaning that it's defined a line that if you uptick not far, you can break out over that line and resume the momentum upside that was existed through January high. Price doesn't show that. Price shows an opposite pattern. It shows what's called a head and shoulder top. Today is the very first day that all the price guys can now scream top completed. You broke below what's called the neckline. It's a line up under the flat lows of the last several months. And you not only broke below it, you closed below it. Okay, now so the price chart is screaming, sell me. Momentum is saying, not so fast. It's not confirming. Momentum is not making a lower low than it did during those other sell-offs. And it's also very aged. And also, if you look across the page at silver, while it's been sort of anemic compared to gold over the last several years, actually silver's trading where it was in March, at the March low. March low close was, it was 1496. Well, right now, May silver's trading 1496.5. So silver's not quite participating in what you see on the gold chart. In fact, if you're an orthodox price chart technician and you're looking only at silver, you see a potential falling wedge pattern, which is a bullish orthodox price pattern. It's not a negative one. So you got two contrasting views of what's going on in these markets, with silver actually having a bullish pending pattern, where gold has this scary one. So we caution our subscribers that, one, we don't flip-flop. If we see a break that we think is serious and likely to end the positive annual momentum trend of gold, we'll issue a warning, and we'll specify a number. But we're not there, and we don't think this break is going to get us there. So anyway, I, as a bull on gold, I kind of liked what happens today, because what it did is it broke the obvious price chart pattern. Now let's see if it really has muscle on the downside, or is it simply a fake out.
So it's probably a lot of price chart guys are saying, "Wow, I'm glad I'm out of here now." Or,
Yep.
Sell this thing for sure. It's a dog. It's going down.
They better keep the action below that neckline.
Okay. Well, we'll be watching, and those, of course, subscribers of yours will be kept up to date on that. And as soon as there's something significant happening, you'll be sending out missives to them, right?
Right. Well, we don't switch polarity on gold very often. We turned very bearish in 2011. Early 2012, just below 1,700. Stayed bearish all that year, and finally the collapse came in 2013. And we didn't turn bullish again until February of 2016. And based on annual momentum, and we remain bullish. So we don't flip-flop every other month. If you did, you'd be in and out of gold 20 times in the last 2 years.
Well, exactly right, and that's one of the reasons I appreciate your work so much. Because it does keep me stable. I mean, I'm one that looks at gold mining shares, and I want to know: am I in a major bull market? Should I stay there for the term? Or do I need to look at an exit? Because we know that in these bull markets, junior mining stocks rise very dramatically. The whole index goes up 4 or 5 times over a number of years, but in a very short period of time, the index loses 80% of its value. I'm talking about the junior mining companies now, not the senior guys. Right. So I'm really depending on you, Michael, to help me and my listeners and my subscribers to know when it's time to get out. And of course, your subscribers are going to have the benefit of having constant feedback from you. And that's why people should really go to olivermsa.com to keep up with Michael's work. Well, Michael, just with a minute left here, regarding the S&P 500, you look at that chart again. You can look at, I think, a head and shoulders. Sort of looks like it may be forming a bearish head and shoulders for the S&P 500. But you could also make the case that it isn't there yet, and that we could get through that right shoulder and maybe onward and upward to something better than ever. what are your momentum charts telling you with respect to the S&P 500?
We are totally agnostic and have no interest in the S&P 500 or developing economy stock markets anymore, ever since 2018's top. If we make a marginal new high in the S&P, and we're open to that possibility, the last high was 2940 plus in September, we could see it going up easily to 3,000 if it wants to. Annual momentum says do not participate. It's likely a trap. Also, for the price chart guys, Edwards and McGee wrote the book, 60-some-odd years ago, Technical Analysis of Stock Trends. And they have a pattern called the widening top, which involves 3 consecutive highs that are each higher than the prior and lower lows. And if you look at the S&P action over the last year and a half, it's developing a potential widening top pattern, where if you actually go up and make the new high, roughly 3,000 area, you've got a potential widening top pattern, and it occurs in bull markets, especially aged bull markets, and it's indicative of a market that has lost sense of direction. Meaning when it sells off, it can take out prior lows. When it goes up, it can take out prior highs, but not really go anywhere. And it's dissipating its energy, so to speak. So I'm not sure whether we make a new high in the S&P, but if we do, we still don't trust it. Momentum says do not trust it. The markets we like in stocks are emerging markets in China.
All right.
Totally different animals.
Yep, absolutely. Well, we'll have to leave it go at that. Thanks again, Michael, for being with us and sharing your insights. It's always very helpful to soothe our nerves on a day like today when gold is going down so dramatically, or seems dramatic anyway, to those of us that watch it.